Hey, what's up guys? John here. Some of the wealthiest families in U.S. history have created and stored their wealth in these unique insurance policies. I'm recently learning about this. 6 months ago I saw some videos online and I'm kind of digging deeper and deeper and deeper into this, and it's really fascinating. What they essentially do is they build out these policies and then they can pull money in and out of these policies tax-free and invest into things like real estate and businesses and cars and jets and islands. It's really interesting. It's fascinating. So Devin, he paints a lot of clarity on how this actually works. So if you're interested in insurance, if you're interested in kind of how this game works, I think you're going to really enjoy this episode.
Hey, what's up guys? John here. So I'm sitting with Devin Burr. Well, his real name, Mr. Burr. What is it on IG? At Mr. Burr?
At Mr._Burr. Yep.
At Mr._Burr. So I've been looking into how Rockefeller built and accumulated and stored his wealth over the course of history. Because if you look at him and you compare him to like Carnegie and some of these other, very, very successful people back in the 1800s and early 1900s, what they did is vastly changed the outcome. And what he's talking about is infinite banking and how to use whole life insurance and how to use certain policies to build and accumulate wealth. And I don't really know that much about it. So I'm going to use this podcast as an excuse to learn more, ask him some questions that I'm sure you probably are wondering yourself. And hopefully at the end, we're all a little bit more educated on the topic. Welcome to the pod, man.
Thanks for having me, dude.
You got it.
It's very humid in Florida. We were talking about that. I'm from Arizona and I'm not used to it.
Yeah, last couple
Walk
days
outside,
brutal.
you start sweating. It's crazy.
Yep. So I saw something on TikTok. You were bankrupt at 2016 and you basically rebuilt yourself.
Mm-hmm.
A lot of people I think right now are at a point where, they were probably doing much better a couple of years ago.
Mm-hmm.
The world's getting a little bit more expensive. And now people are, maybe where you were back then or close to it. How did that journey kind of, move to where it is now?
Great question. Basically, I had to look in the mirror and just say dude, you're 31 years old. What are you doing? Why are you in this situation where you're bankrupt, $300 to my name, couldn't afford the apartment I was living in with my daughter. I was a full-time dad at that point. So I had to move her and I into a one-bedroom from a friend that I was renting. Had to sell my bed, had to sell most of my belongings just to make rent to him. And on top of that, I got my heart broken by a woman I thought I was going to be with forever. So I just had to look in the mirror and say, dude, this is all happening to you because of the actions you're making. Let's take a step back and see what you're doing. Everything in my life was my fault. And once I understood that, then it was easy to change the things I was doing to get a different outcome. So I started reading books, had never read a book, literally had never read a book cover to cover. Started reading books, started watching YouTube videos, started listening to podcasts. Within 1 month, I met my wife. 1 month.
That's incredible because I think that's one of the major one key factor that differentiates someone that's really successful than basically everyone else is accountability.
Yep.
Being able to look in the mirror and be like, I'm the screw up. I'm the one that did this, not this person or that person or my boss, or it's me, all my habits, everything. That was all my fault.
Yeah.
And so you kind of had that one moment once you were selling all your stuff. You're like, okay, this now has to go through a big change.
Yeah. So I just started, like I said, reading books, listening to podcasts, watching the YouTube videos, just feeding my mind good things. And then it started changing the way I was thinking about things, the way I was thinking about money, the way I was thinking about relationships. I was so busy looking for the right woman. When I stopped looking, she found me because I became more valuable. I deserved her then, right?
Yeah.
So I just started saving money. I started getting promoted at work, started making more money. But then I started realizing what most people do. When you make more money, they take more money. The IRS, right?
Yeah.
So as you creep up in your brackets, they take more of your income.
Mm-hmm.
So started maxing out my 401k. I started realizing that's the worst place you can put money.
Yeah, everyone always says max out your 401k, max it out. And it never really made sense to me.
Worst thing ever.
Yeah.
So I just started learning really what wealthy people do. And then I realized I hate being an employee. So October 19 of 2019, I walked into my job at Quicken Loans and I resigned I was getting promoted that day, actually. So they pulled me in the office. Hey, great job. You hit your numbers. Getting promoted to Triple Crown mortgage banker. That was like the top of the top. So no one ever quit when they hit that.
Yeah.
I was like, cool, but I'm quitting. So just kind of bet on myself and grew my wings on the way down.
So when you quit, what was the backup plan? Like how much cash did you have at the time you quit, and what was the plan?
I had about 60 grand. But my wife was working there as well. And she is just a workaholic. She's just outworks everybody. So
Yeah.
she was crushing me
Yeah.
in income. So I'm thinking I could fall flat on my face. I still have the 60 grand. We're still doing well. We don't have a ton of bills.
Yeah.
Her income can more than enough support us. So
Yeah.
I can just go out and not need to make money.
Yep.
Because people can smell that. Like I was
Yeah.
saying, when I needed to find the right woman, when I was trying to do that, I was repelling them all.
Yep.
Right? The second you need something and you come off as needy,
Nobody wants to be around you.
no. But
Yep.
if you're just cool, calm, and collected, you don't need to do anything. You just want to. People can feel that. People can sense it. You know
Yep.
what I mean? So I was able to just go out, do real estate deals, go to meetups, meet people, and just
What
find
type of
deals.
deals are you doing? Like wholesale or?
that's what I started off as. Yeah. Wholesale deals. Then I went to flipping deals. And then I learned like when you flip and wholesale, there's capital gains.
Mm-hmm.
And generally, that's short-term capital gains, which is the same as earned income.
Yeah.
So unless you have a ton of write-offs, which I didn't really have at that point, you're still paying a lot of taxes. So I'm like, how can I pay less taxes? And it's holding on to properties and building wealth. So that's how like Mr. Burr came about,
Yeah.
was because there was the Burr method,
Yep.
and my last name is Burr, B-U-R-R. So I'm like, I'm Mr. Burr. How about I just become Mr. Burr, B-R-R-R, and just be the guy that does the Burr method?
Yeah.
So I just started coining it. We made a rap video. It's like the stupidest thing ever, but it got me like 5 deals
Yeah.
from like a $500 productive video.
Yeah.
Crazy.
That's interesting. So how are you getting those like you just posted it on IG or?
Yeah, posted on IG. I would go on to Facebook groups and just in the keyword search, I would just search cash offers or search whatever and find deals and then inquire about them, underwrite them. If it was a deal, I would take it down. And if it wasn't, I would just keep looking. I had all the time because I quit my job.
So what were you doing once you like when you were selling those deals? Were you obviously just stacking cash, and how long were you flipping deals?
Let's see. So flipping deals from probably about March of 2020 until September, I got my first property as a rental.
Yeah.
That was my first Burr. Did a good amount of them. I think within 8-9 months, we had almost 10 rentals. And then
nice.
in Phoenix, the market just shot up like crazy.
Dude, I've been seeing the numbers people are paying for deals in Phoenix. I'm like, that's absolutely crazy
It was
compared
nuts.
to what it was like 2-3 years ago.
It was nuts. Dude, I
Yeah.
bought a mobile home for 75 grand.
Yeah.
Like the amount of crap that was in this house,
Yeah.
like horror story. When they cleaned it out, they found a dead dog.
Jeez.
Nuts, dude.
Yeah.
But got that cleaned out, did a flip on it, and because the market went up so much, sold it for $375.
That's crazy for a vehicle.
A mobile home.
Yeah.
Yeah. Insane, dude. And it
That's-
wasn't in like a great neighborhood in Mesa, Arizona, but just insane how much the market went up. So took a lot of that and just started making bigger plays with the money.
Today's video is sponsored by Great Credit Fast. Do you want to invest in real estate or possibly Airbnb? Maybe you want to start and grow a company or a business or possibly get debt free. With Great Credit, you're able to achieve all of this and much, much more. The last thing that you want to do is borrow money from a credit card company paying 25 or 27% interest, because when you look at the real numbers and you look at what's actually happening in the economy, that's the worst strategy and it's almost a guaranteed failure. Take a look at this. So if you're borrowing $10,000 at a 27% interest rate, paying $250 a month, it's going to take about 9 years to pay this off and about $16,000 in wasted resources paid to one of these credit card companies. However, with Great Credit, you're able to do a balance transfer in most cases and get debt free for 0% interest and pay this off in a fraction of the time. In 2008, banks started tightening up lending restrictions, and that's exactly what they are doing now. They're getting ready to tighten up lending restrictions, meaning that if you have that low credit score, 400, 500, 600 credit score, if you're in that even low 700s, it becomes much more challenging to get access to money. But if you look at Blackstone, for example, Blackstone, they are using their credit and their relationships to raise money. They've just raised $30 billion to invest in single family rentals. If you want to invest in real estate, you want to really grow and scale during the greatest wealth transfer of all time, you're going to need great credit to do it. We would love to give you a free consultation to see how we can help you at greatcreditfast.com. That's greatcreditfast.com, or give us a call at 561-430-5900. Now back to the show.
A lot of people now, they're looking at, what's going on tax-wise and basically the cost of inflation, cost of the world. They're trying to hold on to more money. And so most people think there's only two options. Go to Dubai, go to Puerto Rico, which is accessible. Some people are even talking, and one of my friends talking about getting a passport in St. Kitts and Nevis for like 150 grand. And you believe you have to like renounce your U.S. citizen, like something pretty crazy, like renounce your U.S. citizenship. I'm not sure if you can get dual. I have to look into it, but he was talking about some pretty aggressive measures to try to, save on taxes.
Yeah.
Because he's looking at, he's like, I don't have any problem, paying taxes, but at the same point, I don't like where the money's going. I don't want to support it.
Yeah.
So, so what was the plan for you, and how did you kind of like go down that hole? And what was your first tax bill that made you kind of get there?
Oh, so my first tax bill was about 90, and it just sucked to write that check.
Yeah.
So then the next tax bill was going to be 400.
Jeez.
So I definitely started making more money.
Yeah.
More you make, more they take, right?
Mm-hmm.
Even with all these write-offs and different depreciation you can take on properties, most people don't have a tax problem. They have an income problem. They need to make more money.
Yeah.
I got to the point where I had a tax problem. I can only write off so much. So some people are in that boat. And I found a vehicle where you can literally pay zero tax legally. And it's what the wealthiest families do. They basically have a private foundation set up because a foundation is tax exempt. And then they have all their income coming from LLCs and whatnot. If they have a partnership, whatever, all the income comes in, and then it goes into a management company through a management fee. So the management company is managing these LLCs. It can charge a fee to do so.
Yeah.
Right.
Mm-hmm.
So let's say I make $1 million in all these companies. $1 million management fee takes all of that million off of the taxation of these companies. Now it's in the management company. Management company can make distributions to my business trust. Once it's in the business trust, it can never be taxed again.
So let's I want to make sure that I have you clear. So there's mainly one entity up here.
Yep.
And then below that entity, there's going to be 10 companies, hypothetically, each making $100,000 each, which would be $1 million collectively.
Other way around. So 10 companies.
Yeah.
Management company manages all the companies.
But is there an entity that is associated to these 10 companies, or you just basically have these 10 companies and then just a management company below it?
Management company below it.
Got it. Okay.
Yep.
And then so that management company below it then can charge a management fee of, X to all those different entities. And then that management company is the one that can also lend money back to those companies?
Correct.
Okay. And
so it's so much easier if you see it, and I've got like it written out on my whiteboard at home.
Yeah.
Because sometimes I have to see it visually to understand how everything's flowing. Because, dude, I've got like 11 bank accounts, 11 life insurance policies. I've got 3 trusts, 11 different companies. Like, I need to see where everything moves. So basically, it's management company. Once the money's there, distributions to the business trust. In the business trust, if I've got $1 million in there, I can go lend that money out and make a 15% return.
Mm-hmm.
That's 150 grand that comes back to the business trust because the business trust is lending it. 150 grand, never pay taxes on it. So now I've got, if I get it all back, $1 million plus the 150, I've got 1.15 million, right?
Right.
I can lend all that out. It can always come back with zero taxation.
But can you increase the number to like why 50? You could go to 25, 50%, or is there like a cap in which like the IRS would flag you?
No, I'm just saying like with deals that I usually do, like I can lend money as a private lender right now at 15%.
Yeah, hard money. Yeah.
So I know I can make at least 15. So I won't touch a deal unless I'm making at least 15%. But yeah, you could make 50. Let's say I buy a house, it's in the business trust.
Yeah.
Same concept. Business trust owns it. If the business trust sells that house, it sells and let's say it's worth $2 million. So there's $1 million in profit,
Mm-hmm.
zero capital gains. There's no 1031 exchanges. There's no having to do depreciation. Zero capital gains.
But so, wouldn't the government look at title and be like, okay, title, you purchased it for $1 million, sold for $2 million, minus cost of agent fees, and there's let's just call it $950,000 net gain on that hypothetical example. Of that $950,000 net gain, they would see that big spread and be like, you owe us $400,000. Like, how does
yes, if it's not set up correctly. So that's how it has to be set up in a proper trust and then a proper foundation, because it's all in the tax code.
Yeah.
Most people, they file a 1040 tax return, right?
Mm-hmm.
So that's what most people know, 1040. This is a 1041. So when you're filing to the IRS, they already know it's under this code. Just most people don't know about it because the tax code is, I forget, I think it's like 7,000 pages.
Yeah.
But of the tax code, all those pages, there's only 30 pages dedicated to 1041. So not many tax attorneys know it.
Yeah.
My tax attorney has studied those 30 pages for 20-something years.
Yeah.
So this is all he does. Super expert at this. So yeah, the IRS would see it, but they're like, oh, it's 1041. It flowed properly. There's no taxes.
Got it. So do you have to buy the deal under that certain structure, or you can just transfer title midway through?
Transferred over.
Yep.
So the LLC could buy it, right? One of these LLCs. I purchase the house.
Yep.
And you just do a quick claim deed to the business trust. Now the business trust owns the house, right?
Mm-hmm.
So yeah, we do that all the time. Like the way we buy properties is my LLC will buy it, do all the renovations, value increase, and then sell it to my wife because she's W-2'd. Easy to get a loan because she's bankable.
Yep.
She's got good credit and she has W-2 income. And she gets it through the company she works for, Quicken Loans. Super easy. So it sells to her, therefore we can dictate the end price.
Yeah.
So if we need to get it for $1 million to get private money, hard money out, closing costs, and her down payment, so she'd make a down payment of, let's say, $200,000. I give her the down payment right back because it comes to the LLC. We're in it for no money. LLC owns it. Just quick claim it over to the business trust.
Yeah. So I was a real estate agent for like a decade in Beverly Hills, and I made a lot more money than my wife. She was a nurse. They loved doing on like a deal or two that we would do it and she'd be on title. They would love the fact that she was associated, even though, I made more money. Having that stable every single month always came in. I'd have big months and then I'd have like 0 months.
Yeah. So sometimes they'll take declining income, even though it's only declining for a month. It's been increasing for 6 months. Like,
Yeah.
Banks are weird, man.
Yeah. So no, I understand what you're saying. So let's say, for example, let's say you're buying a fourplex, right?
Mm-hmm.
You're renting out all 4 units and one of the tenants inside of that property slips and falls. Or maybe they say that you are a slumlord or they have some type of litigation, right? Would they then be able to, they wouldn't be able to sue you because you technically don't own it. It would be the entity. So does that form a shield of protection and liability?
Yep. So that's the main thing is I started studying wealth, Rockefellers. I started studying Andrew Carnegie. Like, how did these people build such substantial wealth and keep it? Trusts.
Yep.
Levels of protection. Like, you want to own nothing but control everything. Because if I own my car, if I own my house, if I own this, if I own that, if I've got millions in the bank, and then you sue me, you can put liens and judgments on everything.
Yeah.
If the trust owns it, you can sue me for all you want. You'll get
Doesn't matter.
You'll get my jeans, my Jordans, and my shirt.
Yep.
My Rolex even is owned by the trust.
Yeah.
So you literally could not get this unless you stole it. Right?
Mm-hmm.
So it's just control everything, don't own anything.
Yes.
It's all protected by the trust.
So there's a famous billionaire. He made a lot of money in the crash of 08. Not Michael Burry. John, trying to remember his name. He made his firm made to like $20 billion. John Paulson.
Okay.
And so John Paulson was getting divorced, and it's like a very interesting story a few years ago. And his wife's trying to sue him. He's worth like 8.4 billion. She was trying to sue him for 4.2. And
exactly half.
Yeah, exactly half. But she didn't know that he's been establishing offshore trusts since the early 90s. and had a collection of these offshore trusts in like Cook Islands and all these different locations.
So she
And-
couldn't really get much at all.
I don't know what happened. Like the net result is that even if she were to make a demand, the court were to make a demand, all he could do is simply send a letter to the trust, and the letter would then, the trustee would likely decline it.
Yep.
And then they would start to go back to the negotiation table. But it's just very interesting when you say like the wealthy, they own nothing, control everything. Is exactly true.
Well, if you think about it, like trusts are basically like a framework of how you want money spent when you're gone.
Yeah.
So my trust clearly states how money should move and should flow. I've figured it out. I've built a lot of wealth in a very short amount of time over the last 3 years just by learning these different things. Now my trust dictates when I pass away, it could be tomorrow, it could be 50 years from now, right?
Mm-hmm.
When I die, it's not a matter of if I'm going to die. It's a matter of when. I have a lot of life insurance. All of that money that's tax-free goes into my trusts, and then my trust has to purchase more life insurance that is structured the same way that grows tax-free. So think about that. When I die, tax-free growth goes to my trust, buys more policies on my kids, my wife. That grows tax-free. When they die, it goes to the trust tax-free, buys more policies on their kids. My family is the same as the Rockefellers, minus some zeros.
Yeah.
That's all they do. They have life insurance policies on each kid that is born into that family at the age of 2 weeks old. That's when you can get it. When that kid dies, the trust becomes more wealthy. It buys more policies on more kids, all tax-free.
So how does the actual, and I heard like, there's a lot of companies out there that actually will buy policies on their employees.
Yeah.
So in the event that employees pass away, the company just grows bigger and
Yeah.
bigger and bigger. Some of the big, I'm not going to name them, but like some of the big wholesalers that, Americans go to probably every week.
Yeah.
Like it's really shocking kind of like how this whole thing is much bigger than I think Main Street realizes.
Mhm.
What does it cost to start, like to set one of these things up? Like let's say, for example, you are $100,000 a year earner, got 20 grand in the bank. You're renting right now. What does this actually look like for that kind of guy or girl?
So what you're referring to with its corporate owned structures, COLI. So there's a lot of companies that do that. There's BOLI, bank owned life insurance, and then there's just individually owned life insurance. So if someone making 100 grand a year, they could qualify if they're healthy enough for about $20,000 a year going into a life insurance policy. So if they put 20 grand in the first year, they can have access to anywhere from like 60 to 90% of that 20 grand right away.
Okay.
So let's just call it 90%. So they put in 20, they have access to 90%. That's 18 grand.
Yeah. About 18.
So they can take that 18 grand, use it for whatever they want. Doesn't matter what it is, tax free because they're getting a loan from their policy. Loans aren't taxed.
Mm-hmm.
So use 18 grand to go make more money, to pay off debt, to buy a car, whatever. Whole time, the 20 grand they put in is compounding, guaranteed tax free.
Can they pull that other 20 out also? Or
No. So the 20 is collateral to
Yeah.
get the $18,000 loan. So think of it like a house. Like when you buy a house,
yeah.
the house is the collateral to get a loan from the bank.
Yeah.
Right?
Mhm.
As the house value goes up, you can get equity lines, you can get more equity. Life insurance is the same thing. You're putting cash in as collateral. It's growing, so you're always able to borrow out more, tax-free. And then the more you pay it back, the bigger it gets. So again, if you take that money to go make more and you're putting money back in, the income that you're making, you're growing that cash value. There's no tax.
So, how would that look over the period of 5 years? So let's say you put the 20 grand in, let's say you're not pulling the money out. You have to make consistent payments monthly to like kind of continue to grow the relationship with the policy.
Or annually or quarterly or twice a year. So I do it annually because it grows the most. If you
Okay.
put in all the money on day one, it's all compounding the whole year.
Yeah.
Opposed to if you're putting it in a portion, you're not getting as much in there to grow. So personally, I put it all in. Some people can't do that. They just put it in monthly.
Mm-hmm.
But what we teach our students is we teach them how to use that money right away. If you just put it in the policy, it's a glorified savings account. It's growing way more than a savings account. It gives a death benefit. It's protected against lawsuits and judgments. Bank accounts aren't,
Yeah, yeah.
right? So it's a better savings account, but if you use it as a vehicle to pay debts off, to invest, to buy cars, to take vacations, if you're using it as a banking system, you're basically just making everything in your life that you use money for more efficient. You're giving the money more uses.
Okay, and so who would be some of the companies that do this that are reputable?
Companies we use, the best one I think is One America. They've been around for 146 years, so super stable.
Yeah.
They've been profitable every single year for 115, I believe.
Yeah.
So Great Depression, World War I, World War II, meltdown of 08, when everything is going to hell in a handbasket, they're still profitable. So it's like, that's where I want to put my money. They know what to do to make money.
Where are they based out of?
Indiana.
Oh, interesting.
Yep. Another great company is Lafayette Life. We use them. Guardian used to use Mass Mutual, but they don't really like people to take policy loans, which doesn't make sense. That's what we use the policies for,
Yeah.
is to use the money.
And so do you have to, is there like a set period which you have to commit to one of these policies?
Yes and no. You basically have, every policy has an efficiency point, meaning it depends on health and different things, but generally speaking, around year 3, year 4, when your growth outweighs the cost of the insurance, the death benefit.
Yeah.
So at that point, you can literally just use your growth to self-sustain your policy for the rest of your life, but then you're just defeating the purpose. You just have a death benefit. You want to use it to build wealth. So you want to keep putting money in it. And because of the uninterrupted compounding, once you get to that year where the growth outweighs the cost, you'd be a fool to not put money in. Because let's say you put $10,000 in, but you have access to 11. Like next year you put in 10, you have access to 15. Why would you ever stop putting money in?
Right.
That's like going to your bank and you put 10 grand in at the counter and they say, Mr. Burr, great news. You just put 10,000 in. You have a balance of 15,000 you can use. Would you like to use all 15? I'd be like, yeah, I'm going to keep putting money in this bank.
Yeah.
It's the same thing. It's just people's mindsets are so screwed up around life insurance because they think of it as a death benefit, but it's life insurance, not death insurance.
Yeah.
You should use it while you're alive. People just don't know how. They haven't been taught.
Yeah,
That's all we try to do.
I think that's one of the big problems today, especially like with TikTok.
Yep.
Is that people read one headline or they'll jump to like one conclusion without doing any research.
Right.
And it happens to me all the time.
Right.
I'll do a video, talk about something, and someone will have their own opinion before they even see the video to be able to form an opinion. And I think the same thing is very true with like whole life and with insurance policies.
Yeah.
Many people think that it's a great thing and it's a great way to build wealth. A lot of these people seem to have put a lot more effort into kind of learning and understanding it.
Yep.
Versus like a lot of the people that have no idea what they're talking about say that it's a scam.
Yep.
Do you see that a lot with when you're doing videos?
Dude, that's like all I see. People, before I even sold policies, I say sold in quotations because I never sell it. I just explain it.
Yeah.
And then people are always just like, oh, well, cool. How do I do one?
Yeah.
And I have a license so I can set it up. So I never sell it. I just explain it. Before I did that, I was just a customer. Like I found out about infinite banking, heard it on a podcast, and then got policies to use for all my real estate. So my first policy was $125,000. I put it in. I had access to 109. So I took 109, did a flip. The 125 is still compounding.
Yeah.
Guaranteed. It's still growing. Took the 109, did a flip and made like 60 grand. So I got my 120 or my 109 back plus 60, paid back my policy. So now I've got 109 sitting in the policy. I got an extra 60 grand.
Yeah.
I can't put more into this policy because that's how they're designed. If I put more in, it would be taxable. So I've got 109 sitting here, 125 is compounding. 60 grand, it made me, let me start another policy. So I started another policy with 60 grand. Now I've got both of them compounding, both cash values, took them, did another flip, made more money, and just kept doing it.
So how much can you put into a policy before you have to do a second one? Is it $100,000?
You decide that. That's the cool thing or your income decides it. So if you make $100,000 a year, you would qualify to put in up to $20,000 per year. But let's say you just want to put in 5.
Yeah.
That's all you can do. 5,000 is your limit. You can't put in more than 5,000 a year. You could put in less. So you're just basically setting your limit for the IRS to view it as a life insurance policy so that it's tax-free. Excuse me. The second you put in more, they view it as an investment and they start taxing you. So let's say you don't have $5,000. Put in 3, put in 4, put in 2. You're just getting less money growing so you can use less. If you keep putting in 5, you're maxing out how much is growing and how much you can use.
Got it. So how do you set it up for you? You have 2 children and a wife, right?
Wife, 1 child, 1 on the way.
Cool. So what does your structure look like? Because I'm in a similar boat. I have a wife, I have 2 kids, but we don't have what you're doing.
Yeah.
What type of structure do you get to set up for your family?
So I have, on me personally, I believe 4 life insurance policies. So I'm the insured person. If I die, the trust gets all that money tax-free. And then I have, I think, 3 on my wife. I'm the owner. I use all the money. I fund it. She's the insured person. She passes away. Trust gets all that money tax-free. And then I have 3 on my daughter. She's the insured person. I'm the owner of all of them. And then I have 1 on my dad. So the reason I did the 1 on my dad, he wanted to retire. He's just got Social Security and then 401k with like $200,000. He didn't think he'd be able to retire. I'm like, well, how much do you need? Told me the number. I was like, cool. I'll get a life insurance policy. You'll be the insured person. My trust will own it. So my trust will pay for the premiums. Here's the crazy part. Remember I said all the money in the trust is tax-free?
Yeah.
I'm funding a life insurance policy that grows tax-free with money that's never been taxed. All legal.
Yeah.
So I'm using tax-free dollars to fund my dad's life insurance policy. It's got instant cash value. I'm just giving it to him as tax-free income. He's going to eventually die. So when he does, the death benefit pays off everything I paid him. The difference goes into my trust, tax-free, buys more policies. Everything is tax-free.
Yeah, it's interesting. Like, what drives me nuts, and like I've seen a woman on TikTok talk about this. She's like a 22-year-old girl. She's just finished college, and she's like, I'm making, I forget what she's making, like almost nothing, like $15 an hour. She's like, I make this, and and she brings up her little pay stub. She's like, they took this out of my paycheck. And she shows, and she's like, then I went to go get a coffee, and then they charged me X sales tax in whatever city they were in. And then she's like, oh, and then I go sell this item, and then I'm now to pay tax again. She's like, this, 20-25% tax is really like a 50% tax. Like half the money that I make, I'm actually just paying back in tax.
Yeah. There's a stat, everyone can look this up, is the average American, out of every dollar they make, they only keep 5 cents. On average. 5 cents.
How does that break down?
Because you've got about 25 cents going, 20 to 25 cents going towards automobiles, car payments, gas, insurance. And then of that, you have about 5 cents goes to interest on that car loan. Then you've got housing, about 35 cents out of every dollar goes to your house. Out of that, about 25 cents is interest. If you look at a 30-year mortgage, the first 8 years, like 90% of it is interest. It's all front weighted because the banks know people don't keep houses.
Yeah, average person stays in 7 years. They want to get their nut right off the bat, and then you sell your house, whatever.
So everyone focuses on rate. Oh, I want that 2% rate, that 3% rate. The bank focuses on the volume, not the rate, right? Because let's say they give you a 2% interest rate, but you pay on it for 7 years and you refinance to get cash out to do your backyard, right?
Yeah.
You just reset the clock.
Exactly.
All that you were paying was interest. Now that you reset the clock to 30 years, they're getting more volume. That's what they care about. So yeah, you've got that. You've got just everything else, food, gas, right? So people save 5 cents out of every dollar. And then financial gurus, financial experts, they all say, take your savings and go make more money. And to make a big return, what do you have a lot of?
Risk.
Risk. Higher the return, higher the risk, right? So if you have 5 cents out of every dollar and You need to go make a big return to beat inflation, to save it for retirement. You have to take on a lot of risk. The older you are, you're less risk adverse, right?
Yeah.
What I teach people is taking on zero extra risk. It's just controlling who's getting the interest, who's getting everything, not making any more money, just putting it in a place that's not taxed. So you have no eroding factor of taxes. Controlling who gets interest. So if I go buy a car, I don't get a loan from a bank and pay them interest because then I'm losing that money, right? I borrow from my policy and I pay myself the interest.
You just have to borrow enough to where you have it in your policy.
Yeah.
Yeah.
So it's all about how much you're putting in. The more you put in, the more you can use it. If you put in $10 a month, what can you do with it?
Right.
But the way I look at it is you should flow all of your money to policies. And you can do that because you can get policies on different people. Like they'll tell you eventually you can't get any more because you're overinsured. You've already got enough life insurance. That's when you start getting on your kids, your wife, business partners. And then you flow all your money towards it. Because think about right now, where's your money going right now?
Well, I'm in a unique situation. So a lot of my money is going to savings.
To the bank,
Yeah.
right? That's what most people do. They get a direct deposit, let's say from their job, goes to the bank. So their money's flowing somewhere. Everyone's is. Once it gets to that place where it's flowing, most of the time it's the bank. How much does the bank pay? On average, 0.06% interest. It's crazy. It's taxable. So they're taxing you on 0.06. So you're making like 0.04. It's not protected. It's FDIC. FDIC doesn't have enough money to protect
Well,
everyone.
right now I put it in CDs, which is paying, I think, my bank's paying me like 4.7 or 4.8, which is like insane when I see like the interest payments. I'm like, that's crazy. But
You're getting taxed on it.
Yeah, but I'm getting taxed on it, and I personally think that the banks in America could be in big. I don't think I'm the only one thinking this. Banks could be in trouble.
100%. And they're always in trouble.
Yeah.
They're getting bailed out by the government. There's banks that have gone insolvent. Everyone's seen this year. Different banks have folded. So everyone flows their money to a place that doesn't pay a lot of interest, that's taxable, that fold all the time, that aren't protected against lawsuits and judgments. So someone sues you, they can take that money. I view it as like, all right, what's a better place to flow money? Where did the Rockefellers flow their money? Where did all these wealthy families like Walt Disney, Ray Kroc, who franchised McDonald's, where did they put their money? Life insurance. Why? It grows guaranteed at 3.25, way more than 0.06. It gets dividends based on how profitable the company is, generally about 2%. So it's growing, let's say at 5%, tax-free. It's protected against lawsuits and judgments. Someone sues you and you got billions of dollars in life insurance, good luck. They can't get anything.
Yeah.
Okay. It is in a place that's stable. Life insurance companies don't fold. They're not insolvent. They're the most stable companies because what does a bank do? They lend out money they don't have, right?
Yeah.
With the fractional reserve. You put $10 in the bank, they can lend out 100. Life insurance, you put $1 million in there, that's all that can be lent out.
Yeah.
They can't lend out more than they have. So they're more stable, grows tax-free, grows way more than any bank account. Cherry on top, it gives a benefit that is guaranteed to happen. Everyone has insurance in their cars, their houses. There's no guarantee you're going to have to use it. Life insurance gives a guaranteed death benefit. You're guaranteed to die. So with all those other things I said, it's a better place to store money. And the more you store there, the more your family's taken care of eventually when you pass away.
So what's the risk? What's the downside?
Great question. One risk is not everyone qualifies. It's life insurance, right? If I have terminal illness, I'm not going to get a policy. That's one risk. Second downfall, this is the only downfall really, is you don't have 100% access to the money you put in right away. It takes a few years. Like I said, around year 3, year 4. So if you put in, let's say $100,000, you don't have access to all of it right away because there's a cost to have the death benefit, right?
Mm-hmm.
But eventually, again, the growth outweighs the cost. And then every single year after that, you put in money, you have access to a multiple of what you put in.
So what's the cost?
Depends
like on
on
that 100K example.
It depends on how you want it structured. So this is getting into like the weeds a little bit. Basically, it's the more liquid you want it, the less cost there is because there's a lower death benefit. So 100 grand, you could make the death benefit as low as like 15 grand a year, or you could make it as high as 100 grand a year. If you made it 100 grand, there's no cash value. You're just getting all death benefit.
Right.
That's what most people think about. They think about whole life as I'm putting in this money. I'm not going to have access to it. It's going to grow slowly. That's a horrible investment, which I agree. We're just lowering the death benefit and then overfunding it. That's what's getting you all the cash value. See what I'm saying?
Mm-hmm.
So if you have 100 grand, let's say 15 grand is the death benefit, the cost. 85 grand is you overfunding it to the limit. Can't put in more. All that is protected against lawsuits, grows tax-free, gives a death benefit, but it's immediately available. You can use it for whatever you want.
Interesting. So what do you think is the average net worth of somebody that should be looking into something like this?
I think everybody, because again, your money flows somewhere. Everyone's does. It's just how much flows depends on what you can do. So if you make 50 grand a year, you're not gonna be able to do as much as someone like if Elon Musk, in which he does have policies,
Yeah.
he can do a lot more, right? So it just depends on how much you're making. Generally speaking, about 20% of your income, gross income, is what you can get approved for.
20%. Do you think that we're going to start to see more people leaning into this as the economy changes? Or like, what are you seeing on your end?
I hope so, because I am a firm believer that if people did this, there wouldn't be a problem with the economy.
Yeah.
What do you think the main reason the economy is bad?
I think it's a mix between corruption, bad policies, and people incentivized to do the wrong things.
Yep. And then also inflation, right?
But that's also the net result of a lot of bad policies.
What causes inflation?
Well, I mean, we could say it's money printing. We could say it's like bad policies, but it's also like what they're doing. It seems like they are intentionally rug pulling America. So we could say that it's, them just printing 40% of USD since 1776 in the last 3 years could be a part of it.
Yep.
But if you also look at what they're doing with energy, they're increasing the cost of energy, which is going to be passed on to consumers, which is also going to raise prices of everything from this drink to my shirt to your hat.
Yep.
So it's a mix between bad policies and
The big thing too, which I agree with everything you said, is also the fractional reserve banking.
Yeah.
So if you put $1 in the bank, they can lend out 10. They're creating more money that doesn't exist.
Mm-hmm. Well, they lend it into existence.
Right.
Yeah.
So now they're lending money that doesn't exist. So they're creating more money in circulation, right? The more money that's in circulation, the less each dollar is worth, right? That's inflation. So if in fact people did this and borrowed from themselves, borrowed from their life insurance policy where there's actually money, there would be less inflation because they wouldn't be putting money in the bank. They wouldn't put 100 grand in the bank where the bank can lend out $1 million. They would put 100 grand in their policy where they're getting compound interest tax free. They can borrow against it and then buy whatever they want from themselves, pay themselves interest.
Yeah.
Craziest part when I learned this is the banks purchase more life insurance than anyone. Billions and billions and billions and billions of dollars worth of insurance. And they store their tier 1 capitals there. So when someone goes to buy a car and the bank lends them money on the car, where do they get the money?
I would guess one of these policies, maybe.
Life insurance policy. So then all they do is they make an arbitrage on the money. So if they borrow from the policy at, let's say, 5%, they charge someone on the car 8%, they're keeping 3%.
Yeah.
And they're not using their money. They're using ours. So they're making stupid returns. Why wouldn't you just cut out the middleman, put the money in the policy, then go directly to the policy instead of going to the bank where they're going to get the money from the policy? See what I'm saying?
Yeah.
People's minds are their mindsets are off when it comes to what's possible with life insurance. And once they know it, it's like, I should have been doing this 10 years ago, 15 years ago.
Yeah.
You know?
So I think that in America, we've had it so good for so long that
Yeah.
a lot of people think the system and everything is going to be That's just everything's gonna remain the same. Everything's gonna take care of, everything's gonna work out long term. And I think that in the coming year or two, we're gonna start seeing more people looking into, things like life insurance and other things where they can become more self-sustainable and not reliant on a bank or reliant on some other third party to kind of save the day.
100%.
But yeah, I mean, it's very interesting to kind of like watch how fast the world's been turning just the last couple of years. And I think we're going to see a lot of wealth being created. I think we're in the greatest wealth transfer of all time. The next 3 years
Oh, dude,
is going to be huge.
The middle class is shrinking quickly, super quickly. And I think that artificial intelligence is going to have a big part of it.
It's going to be a game changer.
It's going to be huge because there's going to be certain people, the first group of people are going to implement it. They're going to use AI to grow their businesses, and they're going to actually become more wealthy using AI, right? I was just listening to a podcast, Ed Milet's podcast. He had someone on that was like one of the brightest minds with AI who was working with Google for the longest time developing it. Crazy that ChatGPT, I think it was 3.0 or 3.5, has an IQ of 155. Einstein had 160. That's insane.
Yeah.
That means that AI is smarter than humans already.
Yeah.
An intelligent human has a IQ of about 120, 130. ChatGPT, just the third version, already at 155.
Yeah.
And that's in like a 6-month span.
Yeah. Version 5 will be like 250.
Oh, if not more.
Yeah.
So it's going to get to a point, hopefully not, where, you see in the movies, like AI is like, I don't need these humans.
Yeah.
It's scary, dude.
So I saw something on, I forget what podcast. They were saying like, 50 years ago, you needed 20,000 employees to have like a huge company.
Yeah.
And now maybe you need a couple hundred. But with AI, you might need 4 or 5 to have like a massive company.
Yeah, so jobs are going to be lost like crazy.
Yeah. And so like all of these big changes that are happening, like I think that a lot of people aren't taking it as seriously just yet, but I think it's going to be undeniable like really soon. I mean, we use it for my credit repair company, Great Credit Fast. Like it's absolutely insane like what you can do with tech. And I think it's just going to be, this wealth transfer is going to present opportunities for people to go from having, a couple grand to millions of dollars. And then you're going to see people that are very stable ignoring the reality that are going to start dwindling in wealth because of it.
Because they're going to keep their money in the bank where it makes them 0.06%. And it's just going to get less and less value.
And hit by like 20% real inflation. Like they say inflation is like 3%. Give me a break.
It's way more.
Yeah.
Because there's so many things they don't take into account when it comes to the inflation, right?
They select the basket of goods.
Yep.
So they select the basket of goods. Meanwhile, like everything else is like going through the roof. But I think that all this is, there's 2 ways of looking at it. And I think that all this could be great for an ambitious entrepreneur or just somebody that is looking at the world from the perspective of somebody that is a winner.
Yeah.
And they're going to look at it and be like, I'm going to win.
100%.
And like those people are going to crush it. Like, it's the last couple of years for me have been probably the best in my whole life. And I think the next couple are just going to probably be the same for you as well.
Absolutely. It's all about who you surround yourself with, in my opinion.
Yeah.
And that's why I love like the podcasts. You get to bring people on and associate with them.
Yeah.
Great minds. And just being, you get to learn from, right? Learn things that you wouldn't have otherwise. And then you get to associate with them. Like hopefully we keep a friendship.
Yeah.
Whenever I'm out here in Miami, I can hit you up. If you're in Phoenix, hit me up. So you start building a network of more successful people.
Yeah.
Right? The saying, like, it's so cliche, but it's true. Your network is your net worth.
Yeah.
It's so true, dude. To the beginning of the podcast, when you kind of talked about what I changed, that was the main thing I changed, is who I hung out with.
Yeah.
Like, the second I started looking like, all right, that friend talks only about the past. My past sucked. Why do I want to talk about that?
Right.
I should probably stop spending as much time with them. This friend only talks about going out and partying. Maybe I shouldn't talk to him as much.
Right.
Let's go talk to this person that talks about money all the time, real estate, that talks about paying less taxes. Let me talk to them more. Let me associate with that person more. And product of your environment. If you hang out with out of shape people, you're probably going to be out of shape. You're going to be eating crappy food. You're not going to be working out. You hang out with people that are jacked, you're probably going to get in shape.
Yeah.
It's just, it is what it is.
Yeah.
So hang out with people that you want to emulate. You want to be wealthy, hang out with wealthy people. It's that simple.
Yeah, see, like a lot of people hear that and they're like, oh, okay, like, but how do I hang out with wealthy people? Like the podcast format is so easy to create, and reaching out to people with DMs and messages, people will, believe it or not, respond, so long as you don't hit them up with, let me work for free or some stupid line like that.
Right.
Like an actual line of like, let me create some value for you.
Right.
Like with this podcast, I had a guy, he had a $2 billion real estate portfolio in Miami, in South Florida, 10 million square feet. And I just sent him an email and I was like, hey, will you come on my podcast? And he called me. He's like, yeah, I'll come on. I got to sit there and talk to him about where he sees, Florida's real estate market. And I got to learn a hell of a lot of information for completely free.
Right.
And I got to talk with all these people for free. And I was picking this up, and I kind of mentioned this in the pod or before we started filming. Like, look at the Nelk Boys. Like, they went from being pranksters, like all these little jokes, to now they have, Mark Cuban, Elon Musk, like all these big names on their show. And now by association, their brand is way
Huge.
bigger than pranks ever could be.
100%.
With Happy Dad and all these different brands, Dana White, it's like genius, like just sheer genius. And all they did was they just scaled their authority through association.
Yeah.
And yeah,
One thing I would recommend to people that are going to go down that road, and you touched on this before we started recording, is like the race. What was it, the race to 20 episodes?
Yep, 21 episodes.
Get to 21 episodes, you'll outlast most people.
Yeah.
Also, what I would recommend people do is reach out to people that have a following, right? So if you reach out to someone that's got like 100 followers, they're going to share it on their platform to 100 people.
Nothing, yeah.
Reach out to people that have a big following, because then they're going to be promoting you on their platforms, right? So across all platforms, I think I have about 1 million followers.
Yeah.
So me putting this podcast, these clips on my stuff will inevitably bring more traffic to you, more people to you. You doing so will bring more people to me.
Correct.
It's just people helping people,
Yep.
right?
Yeah.
But again, it's the right people. Who are you associated with? It's so big, and I can't understate that enough or overstate that.
Yeah. Like, you remember that movie Pay It Forward?
Yeah.
Like when he was like, he had like the board. I'll have like Sam, the editor, you put that board here. Like, he had that board and he's like, oh, if this person will help this person, these people help these people. And before you know it, it's like hundreds and hundreds of people were helped because of this one initial action.
Yeah.
And just like you said, like right on the money. Like, and that's kind of like, I had that one concept here as well. Like, there's a certain amount of like clout, ideally, that the person will have them on the pod. So that way there's like a benefit, like a mutual beneficial, like they're growing as well. And it's like a big win.
Yeah.
But yeah, you're starting a podcast, you said?
Yeah, dude, it's starting next month. Super excited about it. And it's the Mr. Burr Show. So whoever's watching, hopefully it's out by the time you drop this one. But I'm excited about it, just to be able to get around people that I want to get around, learn from.
Yeah.
Like you said, it's free for me to do so, and it makes me better. In turn, it helps other people. What I've learned in my life is the more people you help, the more money you make.
Yeah.
Period. I used to always try to chase money, chase women, chase everything, and it always eluded me, right?
Yeah.
The more I chased money, I'm always chasing after it. The second I stopped chasing money and started just thinking, how can I help more people? Let me put this video on TikTok about what I learned. It's helping potentially millions of people. Then followers started coming. I learned how to monetize them. So I'm not chasing money anymore. I'm just chasing giving value. The more value I give,
Yeah.
the more money's chasing me.
Yep.
It's insane.
Yeah.
So that little switch is, I'm excited just to be able to give more value to people by interviewing people and just having different concepts, different things brought up that I don't know about. So I learn about it, and then other people are helped through being in my platform.
Yeah. So it's like when you, and this happened to me as well, like when you go to a new platform like a podcast, all the other reels and shorts will already have like a lot of views that you already have. When you do the podcast, sure, some of these people will come over, but it's almost like reaching for a whole new audience. And it's like you kind of like start over in some regard. But it's like, and I'm saying this for like motivation for people that want to start a podcast or start like anything. In the beginning, it's like not so much about having like massive amount of views, but more of like having loyal followers.
Yeah.
Like those loyal followers are worth, I'd rather have one loyal follower 100 random follows on TikTok that are for like comedy or some random skit, right?
Yeah.
And so like that podcast, that long form relationship that you're going to build with your audience is going to be, I think you're not going to chase money, put it that way.
Yeah. It's so true, man. Quality over quantity. It's so true.
Are you going to go mainly after like the business niche? Is that like,
Yeah, business and just self-development, you know? So got a guy that's coming on. The first one is going to be, he's a partner of Kevin O'Leary
yeah,
from Shark Tank.
yeah,
He's got a tax company. So just teaching people how to like save on taxes.
yeah,
He also has franchises. So helping people learn how to do that. Next person is an IFBB pro that I know, bodybuilder. I've never seen this guy over 9% body fat.
insane.
Literally, he's just always in peak condition. So picking his brain, like what he eats, how he stays healthy, how he stays in shape. So again, that's personal development, right?
Yeah,
So it's just getting a broad spectrum of just helping people and then also sprinkling in business, sprinkling in some comedy, things like that.
yeah.
I'm excited about it, man. It's gonna be fun.
Are you going to do like an episode a week?
Yep, one a week. So
Yeah.
probably every Thursday I'll drop one, but might be recorded on a different day, but it'll drop every Thursday.
Yeah, that's the way to do it. Because then by the end of the year, you'll be, you'll pass that 21 episode mark,
Yep.
and you'll already be like right on your way. Are you going to post on YouTube or?
Everything. YouTube, I'm gonna do shorts on YouTube, chop everything up, do reels, TikTok, Instagram. I haven't really used Twitter. Not sure if you've used Twitter much.
I only have like 500-600 followers on Twitter, and
Yeah.
like I like scroll Twitter, and like I'll learn and pick up like from some accounts that I like, but I haven't cracked the code on that.
Yeah.
I don't know, like TikTok I think is a little easier, IG is a little bit easier, but I feel like YouTube is probably the easiest of them all, even though like a lot of people probably disagree with that. I think because if you look at the watch time on like TikTok or IG, the average watch time on a reel is 3 seconds, which is
Crazy.
like nothing. Like
You have to
people,
really catch their attention right away.
yeah, like they don't care. Like people watch it, be like, okay, whatever, like 3 second thing. But if someone watches you for 50% of a 10-minute or 20-minute video or an hour podcast and they watch half of it, the commitment level is like night and friggin' day.
Yeah.
And it's like, and that's why like even the podcast, some of my podcasts, we've had the best one we've had so far is like 18,000 views, but there'll be like 2, 3, 4, 5,000 views. But I feel like those few thousand views are a hell of a lot more valuable than a video that I did last week that got 300,000. That
Yeah.
was like about, money. There was like a 10-minute video that I posted on YouTube. It like got 297 or like 300. But I'd rather have 5K, 8K on the long form pod than that.
It's true, man, because I started trying to grow my podcast early this year. Or not my podcast, my YouTube.
Yeah.
So I started actually working on it and posting videos, getting them edited, looking at the different analytics. And I finally got monetized. We had to have like, I forget what
4,000 hours watch time.
Yeah,
1,000
and
subs.
it's within 12 months. So like as stuff would drop off, I was like, crap. So I had to make more.
Yeah.
But finally got to it. I'm at like 6,800 subs. Nothing crazy. But as soon as I got monetized, I kind of like put it to the side.
Yeah.
It was a lot of work to.
Dude, people have no idea. I get people come up to me on the street, they'll DM me, they'll even like I have people reach out to me all the time. Oh, I want to get on YouTube. I'm like, you don't want to get on YouTube.
It's so
Like,
hard.
It is more work being on YouTube than it is to have like a normal job.
For real.
Yeah.
But the crazy part is the people that watch my YouTube content and come over and want to get a policy for infinite banking, it's like the easiest client because they have paid attention. They've listened to
Yep.
20 minutes here, 15 minutes here of me explaining something. They watched all the videos opposed to, just 60 seconds scrolling on Instagram or TikTok,
Yeah.
right? If they even stayed on for 60 seconds, right?
Yep.
So the people that come from YouTube are the best clients, hands down.
Night and day. Like I do I'll post like a little ad for like GCF, Great Credit Fast in a video. And I'll just be like, oh, if you have late payments, medical bills, collections, foreclosures, bankruptcies, go on the website, schedule a call. Those people that schedule a call, it's like straight, I want to fix your credit. Like just straight to the point. I want to fix it. Help me. Boom. But if you like run an ad to like fix your credit, you're like, oh, well, and they have like so much reservation of fixing their credit. And it's like a basic process. Like, do you want to have horrible credit and not be able to get financing? Or do you want to fix it?
Right.
And it's like, well, I'm just not sure. Okay, well, then you're not going to be a fit.
Right.
But like on YouTube, it's like straight line. That's why I'm like, I look at YouTube as like the perfect funnel for
Right.
everything.
It is.
But it's very like I learned a lot with YouTube. And for the people that are thinking about like getting started, I watched like a little skit on Mr. Beast, a bunch of them, about like how to actually do a video. And I didn't start doing it until like a month ago, but my views jumped dramatically since
Really?
then.
What was it?
The first 30 seconds of the video, if you have more than 20% drop off, like between 18 and 20% drop off, YouTube's not going to suggest it. So like the hook has to be like on point, and I've been paying an editor to like edit the videos really, really good in the beginning to try to get that drop off like 15%.
And what's the time frame?
First 30 seconds.
First 30 seconds.
Yeah.
So it has to be a 30-second hook opposed to like on
You have-
TikTok, Instagram, it has to be like a
2 seconds.
2-second hook.
Yeah.
Got
So you
it.
have to you have to tell them what they're going to get, how it's going to work, and what benefit they're going to get to making it to the end.
Got it.
So you sell the hell out of it first 30 seconds.
Lots of visual stimulation.
Yep. Like
Got
news
it.
clip, like anything you can bring forward. You have to have a banger of a thumbnail that's going to get like 10, 11% click-through rate, a great subject line. And you have the subject line, the thumbnail, and the great hook, and the video is going to do well.
Got it.
But if it misses any of those things, it bombs. And also they pay attention to watch time too. So the longer that someone watch, the more they're going to suggest it.
Got it. Good
But,
to know.
Yeah, we're trying to get it on the podcast, but the thing is, like, I think a lot of people have TikTok brain to the point where it's like watching a 1 hour pod is challenging for some, but the people that really want to learn are going to watch it.
And those are the people you want.
Yeah. Well, dude, it was great connecting with you, man. I learned a lot about life insurance and whole life, and I had no idea. Like, I've always just kind of like scrolled and kind of like wondered. But then I've read a book, Rockefeller. It was
What would
I
the
read
Rockefellers do?
Yeah, I didn't
By,
read the whole thing. I've just read like the first chapter or so.
Read the rest of it. It's by Garrett Gunderson.
Yeah, it's a green cover.
Yeah.
Yeah.
Yeah. Read that. Garrett Gunderson, I met him at a speaking engagement I was at for life insurance.
Yeah.
Great dude. He's like, he looks like Jesus. Like he's got long hair and
Yeah.
like, it's crazy, but he's like such a beautiful mind when it comes to finances. And he's all about life insurance, overfunded life insurance, has to be overfunded. Because otherwise it's just a death benefit.
Yeah.
So what I talk about, what I do, overfunded life insurance, read that book. That's when I read that book, that's when I started getting trusts in place
Yeah.
because it talks about how the Rockefellers did it. And one thing I would just suggest to anyone listening, obsess over this kind of stuff, because if you don't obsess over something, you're just going to be like everybody else.
Yeah.
Like Grant Cardone made an amazing book. I'd recommend reading it, is Be Obsessed or Be Average. It's so true. So anything you want to be exceptional at, you have to obsess at it.
Yeah.
So if it's money, if it's finances, obsess over it. Learn everything you can. Ask questions, read books, podcasts. Take this podcast, listen to it over and over again, what we talked about. If you read a book that resonates, read it again and again and again and again. If you want to be great in a relationship, obsess over it. Otherwise, you're just going to be average.
Well, before we close this out, a question. What are your thoughts on term policies?
Horrible.
Yeah.
It's renting insurance.
Yeah.
That's all it is. And it's the most popular because it's the most
Effective or the cheapest people to get into?
yes and no. That's one reason. The main reason is because it's the most advertised.
Yeah.
Why would the insurance companies advertise that the most?
The most profitable for them.
Because here's what they do. They have really smart people. They're called actuaries.
Mm-hmm.
They're nerds upon nerds that calculate data and take a sample size of people, look at death rates. And they know that very, very few people are going to die before the age of 65. It is what it is.
Mm-hmm.
So when do most people get life insurance? When they have kids, right?
Mhm.
30 years old, let's call it. You have some kids, you're like, oh, I need to protect life insurance in case I die. So they get a 20-year term policy. They're 30, it's going to expire at 50. The likelihood they're going to die is very slim. So it's very cheap, but when they hit 50, let's say they had $1 million coverage. That coverage is gone. The insurance company just kept all that money.
Yeah. It's all profit for them.
So now that 50-year-old guy, he's like, crap, well, I need $1 million in life insurance.
Reset at zero.
He's got to get life insurance as a 50-year-old instead of a 30-year-old. He's more likely to die.
Mm-hmm.
So now it's way more expensive. He might not be able to afford it now, right?
Mm-hmm.
So term policies is you basically making a bet with the insurance company. You're betting you're going to die,
Yeah.
and they're betting you're going to live past the term. They win that bet 99% of the time. Term policies only pay out 1% of the time. It's the worst policy you can do.
So what would you suggest for somebody like me? I feel like, well, I'm a little bit more, like I'll take a little bit more risk in life than I think most people. Like when Clip jumped into the Amalfi Coast 6 months ago,
Dude,
my buddy,
the Amalfi Coast?
Yeah.
That's like my favorite place on earth.
yeah,
When
really?
you cliff jump there?
Yeah.
It's freaking amazing.
And we're buying a small little 6-seater plane that I want to fly to the Bahamas.
Hell yeah.
And I'm like practicing flying every
Just swing by Phoenix.
Yeah, pick you up. Yeah. But like for somebody like me that I think has a higher probability of something happening compared to the average person on the street, what would you suggest? And I also make more money than the average person. What would you suggest for that type of scenario?
So I would suggest doing an overfunded policy. Start putting money there, and then you always want to put the money there first before you use it. Because think about if I have $1 and I give it to you, how many uses did that dollar have?
Right.
One
Zero.
use. If I have $1 and I buy a stick of gum, how many uses did it have?
Right. Just
One.
to gum.
If I put that dollar in a policy, it's growing, compounding, guaranteed. Then I use it to buy that gum. How many uses does the dollar have now?
2.
If I take that dollar, put it in the policy, borrow it, lend it to my business, create a note between myself and the business, so the business pays me back interest, tax deduction, into my policy. I get the money back here. Then I take and buy the gum. How many uses?
Right. But like, what about the example of like, let's say, for example, someone passes away the next 5 years and you build out the policy in advance now, but say some rare fluke scenario happens, like you're flying a plane and the engines goes out over, maybe you're flying to Mexico, engines fail over Cuba or past Cuba, you can't turn around. That type of person that's taking those types of risk. But he has a stay-at-home wife and kids.
So that's the thing is, let's say you got a policy like I'm talking about.
Yeah.
Me personally, I have, I think around 600 grand a year going into policies. And that gives me a death benefit of, I think, just over 30 million right now. Okay.
Mm-hmm.
So the way these are structured is the cash value grows. As the cash value grows, so does the death benefit. So by the time I'm likely to die, the death benefit might be 100, 200 million.
Right.
Right. But let's say I die tomorrow. I've put in, let's call it $3 million. Let's just say that's what I've put in. $3 million. If I use all that, I use all the cash value and I go buy real estate, I go buy whatever I want with it. What's going to happen if I passed away tomorrow and I have all that 3 million used, it'll be deducted from my death benefit because I didn't pay it back.
Right.
So instead of my family getting 30, they would get 27
27.
million tax free, but they'd also get everything I bought with the 3 million. You know what I'm saying?
Yeah.
So you want a policy like that because you can use the money while you're alive. And when you die, the death benefit pays off whatever you didn't pay back, plus some, tax free. And then the longer you live, the bigger that death benefit gets.
Cool. Appreciate it, man. I learned a
Of
lot.
course, man. Of course.